And welcome. It's Mary Ellen McGonigal here today with a very special presentation, and it will be all about providing you with the details of a proven system that has uncovered every bear market bottom. We'll go ahead and review using historical precedent and a whole lot more. So let's go ahead and get started here. I did want to go ahead and begin by taking a look at the current markets. And this year certainly has been very, very difficult. I know many of you, I'm sure, have felt the pain. This daily price chart view of the S&P 500 is taking us back to that high that was reached at the very beginning of this year. Of course, we did see the markets deteriorate into February, a whole lot in the way of volatility. And the S&P 500 eventually here in the mid area of June, we did hit that bear market status. However, we have had a subsequent rally from that. And then, of course, more recently, back to retesting the lows. Let's take a look at a certainly more current chart, but more to that is the chart is now marked up. And what I'm sharing with you here is how really helpful it can be if you add these overlays. I have the RSI, that relative strength indicator, up here at the top. And then in the bottom portion, I use the faster moving stochastics momentum indicator. So these lines here, perpendicular, are pointing out and highlighting how when we do have these bear market rallies, you can identify that they are over. You're looking here at the beginning of the year after the broader markets peaked in price. The momentum did shift the RSI in negative territory, heading lower. We did break below this 50-day simple moving average, rather critical. And then also we had the stochastics entering into negative territory. As we progress further, I will share with you what occurred back here relative to this break that eventually went on for a much longer period of time. And then as we move forward, another secondary rally attempt here. And again, using these momentum indicators to signal that that rally had ended. Now, once we entered into bear market territory here in mid-June, these rally attempts become more bear market rally attempts, and their failure will be a little bit more we can be more confident in the fact that they aren't going to last that long. However, we did see a very significant June into August rally, and I'll share with you the dynamics that led us into that rally. And then more recently, another pullback as this market rally did find resistance at this downward trending 200-day simple moving average, again, using those momentum signals to tell you to exit had you participated in this bear market rally. So let's move on. Take a look here at the NASDAQ composite. Of course, the NASDAQ has gotten hit quite a bit harder than the S&P 500, and we did see a similar move away from growth stocks here in the beginning of the year. I'm going to share with you excerpts from my MEM Edge report, how we were able to identify that move away from growth into certainly more value, less certainly growthier names were under distribution. So as we move forward, same dynamics with identifying when this rally in March did dissipate, turned into distribution as those momentum indicators turned negative. And then likewise here, further on into August of 2022, when we did not make it even up to that 200-day. That's where we found resistance. That's often the line in the sand for these broader market indices. It's going to be the 50-day to the downside. Once we break below that 200, it now becomes resistance as these rallies during a bear market period take shape. So taking us back to the beginning, this is the first half of 2022, and I shared with you how the broader markets were really suffering and struggling. But there was one sector that actually not only had a positive return, it had a very significant return, and that is the energy sector. It was up 34% from January through the end of June. And we can certainly compare that to consumer discretionary and the NASDAQ technology. Some of these growthier areas did get hit very hard, but energy stood firm and actually outperformed. So I'll share with you the dynamics there. So with my MEM Edge report, I did identify the move into energy stocks at the beginning of January. On January 4th, I did add Occidental Petroleum to my MEM Edge buy list. And the move was all about both technical and fundamental reasons. So I'm sharing with you that as the stock continued to climb higher, the momentum indicators remained positive up here. As we progressed into the June period, we did see the momentum shift with that RSI trending downward. And then I have a moving average, convergence, divergence, another really powerful momentum indicator. And that black line shifted down in below the red. And then we had that break below that 50-day that I talked about. And this is when we removed the stock from the suggested holdings list. Subscribers to my MEM Edge report, this was an 87% gain in an otherwise very difficult market. So you will find periodically these pockets of strength that are able to override what is taking shape elsewhere in the markets. It's not entirely common, but let me share with you why this particular area did in fact outperform. As we move forward, we'll get into that. Also today, we're going to talk about the signals that the markets in a bear market period, when have they bottom, what you need to be on the lookout for, and then also how once the markets do bottom, what you are going to be on the lookout for so that you can get in front of the names that will go on to outpace the broader markets once they turn bullish again. Also, how you can apply those macro fundamentals and combine it with the technical charts. That's going to be really your most powerful weapon. I've worked with top fund managers for many years throughout the world. 2 of them were Morningstar Fund Managers of the Year. During that period, I was working with them, and I will tell you their outperformance had everything to do with that ability to look at the underlying fundamentals of the stock and the company, and then marry that with a bullish chart pattern. Also, we're going to take a look at bull and bear market cycles and knowing when you should be preserving your capital, have more cash at hand, and when you can get in and out by way of these bear market rallies. So a little bit of information as to who I am. We'll get through this. I do have over 25 years of experience both on and with Wall Street. I started my career on the trading floor of Goldman Sachs, and from there I went on to a very junior position at an asset management firm. But I did move through the ranks to the point where I was managing over $2 billion in assets. And my work with equities began when I joined William O'Neill and Company. So a lot of the work that I will be sharing with you and the information today is based on Bill O'Neill's proven methodology. It's a system that is based on going back through every market cycle from the beginning of the 1900s and examining the key characteristics, not only in winning stocks that go on to far outpace, but also what to be on the lookout for when that uptrend is over. So more recently, I do have my own investment research firm with my top performing MEM Edge report. And of course, I do lots of work here at stockcharts.com, which I absolutely enjoy. So I do, as mentioned, have a long history of picking winning stocks. That's a big part of my work. Of course, when we are in a bull market cycle, it's a lot more exciting. But as you noted earlier, I was able to capitalize on that move into energy. That Occidental was one of 4 stocks that we added at the beginning of January, and they all went on to have superior gains, certainly relative to a negative market. So using a consistent system is, of course, going to be your advantage, not only having a proven system for market bottoms and market tops, but also uncovering those stocks that have the predisposition, the characteristics to really go on and outperform. So rather than chasing the latest fad, you are well served to really work with a system that aligns with your sensibility, your beliefs in the markets. And that is going to be one of the keys to help you in these treacherous market periods and beyond. So getting back to Occidental, I'm going to be sharing with you some of the characteristics that not only got us into the stock, but once you enter a stock and we're in a bear market period, you're going to want to need confidence to continue to be able to hold on to that stock. So here we are with the date that we did enter into Occidental back here in the beginning of January. And this fact that the energy group, XLE, is the ETF for energy, and that group turned positive. And that was the real key that gave us the confidence that this downtrend reversal had potential. So one of the first items that occurred was with Occidental, it broke back above this red 50-day simple moving average. And then we had the outside momentum indicators turn positive, the RSI up here above 50. And then likewise, that MACD, we had an early black line up through the red signal. But then once this moving average convergence divergence entered into positive territory, those three factors gave us the ability or the confidence that Occidental had much further upside ahead. And then as the stock continued to progress, and these are truncated notes from my MEM Edge report that comes out twice a week with alerts beyond that as needed. But here we can see that the stock OXIY had broken out of this high tight flag formation. So we had talked about it in the Sunday report that it was exhibiting the characteristics of this high tight flag. We were on the lookout for that breakout when it occurred. This SB indicates that we are telling subscribers it is a strong buy at that point. So that's what that is signifying. So as we move forward, we did, of course, see tensions with Russia invading Ukraine that pushed oil stocks quite a bit higher because there was a lot in the way of oil delivery prospects being halted. And so energy really were boosted by that pickup in the price of oil. And then we did see Warren Buffett take interest in Occidental. That gave the stock a real boost. And then as we continued forward during this period, we were advising to hold the stock, and more news with Warren Buffett continuing to accumulate pushed the stock higher. So here, what I'm talking about is marrying that chart display with the positive momentum indicators with information relating to outside occurrences, either in the markets or within the industry group with oil prices or stock specific, giving you that confidence to add to your position as the stock continued to ascend. So I talked about the fact that the broader markets overall really suffered, certainly in the first half of the year and beyond. However, energy stocks did outperform. And I'm sharing with you one of the reasons. We already talked about the fact that the price of oil was continuing to be elevated above that $100 per barrel price, but also interest rates were on the rise. And rising interest rates are tied to rising inflation, which we all are well aware of now. And energy, this sector is the best performing sector in the S&P 500 when inflation rises. So let's take a quick look at the yield on the 10-year Treasury. And this is taking us back to the beginning of 2022. And you can see generally, aside from periodic pullbacks, that interest rates were on the rise. So this was another critical piece and backdrop item that also gave us confidence that those energy stocks could in fact perform in an otherwise tough market. So I'm sharing with you a couple of excerpts from my reports early in 2022. And the purpose here is to highlight again other key components that would give you confidence to get into a particular group that is bucking an otherwise downtrending period. So on that January 9th period, we talked about energy stocks. In the week prior, they were the biggest gainers for the week. And the reason was higher oil prices and rising interest rates. Also talked about the current increase in rates, why that was taking place, so that you could have confidence to know that rates were going to continue higher. And the fact was, at that time, the Federal Reserve was beginning to be concerned about the recent spike in inflation and the way for the Federal Reserve to stem those rising inflationary period is by increasing interest rates. So that was the backdrop. And then in addition, talking about the fact that not just oil prices and energy stocks, but other commodity related stocks fare well during these periods of high inflation. Energy is historically going to be your biggest performer, but other commodity areas also are going to rise in this period of high inflation and a rising interest rate environment. So we want to take a minute here. I'm going to pull back the curtain and talk a little bit about why and how the markets began to get into trouble at the end of 2021. So we're looking here at a daily price chart of the S&P 500 that takes us to the beginning of December of 2021. And at that time, on my weekly December 1st report, I did mention that at this time, we're negative on the near-term prospects for the market and would take a more defensive stance. The reason that we did get defensive on December 1st before the market peaked is quite simply the S&P 500 broke below this 50-day simple moving average. And if you can take a look here, the volume characteristics were quite high. And we had 3 distribution days clustered together with these last 2 days on very high volume. We also had the RSI on the daily chart turn negative, as did the stochastics. So at that time, we did turn negative on the near-term prospects for the markets. So in essence, another backdrop item at that time to be very aware of is the fact that when we are in a rising interest rate environment, the areas that are going to be most negatively impacted are big technology and growth names, and not just large names. Technology and growth names overall are going to be underperforming simply because rising interest rates lower the value of future earnings. So as interest rates rise, the value of that future cash flow is going to be discounted as well. So overall, this group is going to be the most sensitive to a rising interest rate environment, but they are going to be the most impacted in a negative way. Let's take a look here. Quite simply, this is a comparative chart showing the bar charts here are the NASDAQ composite. This is taking us back to November of 2021. And in the line bar here, this is a view of the yield on the 10-year Treasury, again, taking us back to the end of 2021. And as you can see, as interest rates increase, quite simply, the NASDAQ, which is a very heavily growth-laden index, is in a declining phase. So as we move forward, this is July of 2022, you can see that same dynamic taking shape. This is that rally that we experienced at the end of June into the end of August. And it was very much during a period when interest rates were declining. This is the S&P 500 also had a rally phase here and also driven by interest rates. But overall, this growth-heavy NASDAQ and tech-heavy NASDAQ is going to be even more impacted. So as we move forward toward the fourth quarter, you can see that interest rates are on the rise. And as such, quite simply, the NASDAQ is deteriorating. So that's an important backdrop item to keep in mind as we progress through this bear market period. So here's an excerpt from my January 9th MEM Edge report. This is a view of semiconductor stocks. They are a very big component of technology and the NASDAQ as well. And when they get going, you can really experience nice outperformance in the group. However, as with any industry group or area, you want to be aware of when they are beginning to move out of favor. So taking us back to the beginning of January, we did cite the fact that the week prior to this January 9th, semiconductors were down 4%. More importantly, they broke below support. That's that 50-day simple moving average. And we can see, and at that time, we discussed, we had anticipated further near-term downside for semiconductor stocks, similar to other periods when interest rates were on the rise. So we did remove our semiconductor stocks from our suggested holdings list, and you can see that, in fact, they have gone on to deteriorate quite a bit more. And then also on that January 9th report, we cited that the prior week, there was a very sharp rotation away from those growth stocks. And due to the fact that interest rates were on the rise due to inflation fears, and at this time, we would refrain from purchasing growth and instead favor the energy stocks that we've highlighted. And also financial stocks were beginning to outperform at that time as well. So let's talk about where we are at this period. It is toward the end of 2022, and it's been a very tough time. Certainly, if you are an active investor, you may have made progress periodically, but for the most part, it has been a very much declining period for the broader markets. We have inflation. Statements from the Federal Reserve are highly impactful at this time. And I do want to add that as a studier of the markets and working with Bill O'Neill directly for many, many years, it was often cited, and it has been proven, that Federal Reserve and monetary policy is going to be the primary driver of the broader markets. And that's both to the downside and the upside. And I'll share with you an example as we move forward. But not everyone is aware of that. So I thought I would point that out as something to have in the back of our minds. So the question is, what are you going to do, if anything, but when will the markets truly bottom? So what does a real market bottom look like? We will get into this. From my work, I have actively sat through 4 bear market bottoms. And by that, I mean that I was in front of my computer watching the markets every day, but also during 2 of those bear markets was advising professional money managers. That would be the 2000 into 03 and the 08 into 09, the more severe bear markets. Beyond that, also was very active with my MEM Edge report during the 2018 bear market, as well as the 2020. So lots of experience that are as a backdrop to what we are going to be reviewing here. But I did want to share that when the markets bottom, it's counterintuitive, but often the headlines are always quite negative, particularly for prolonged bear markets. A lot of that is because this bear market mentality is still lingering. And not every bear market cycle does go in straight into a new bull market. So we're going to talk about that every market bottom signal does not indicate a prolonged bull market. So, for instance, we can take a look at 2008, very one of the toughest periods, financial crisis in the markets. We did see what I'm calling a head fake bottoming in the markets in the fall, November of 2008. The real true market bottom came in March of 2009. So let's take a look at the differentiator between those 2 periods. So this is a look at the S&P 500. We're looking at a daily price chart back in that 2008 and 2009 period. So this is what I'm calling the head fake. Actually, it was in December when a lot of headline news, there was talk that the markets had, in fact, bottomed, but they did not. We did have that other extra leg down. And it wasn't until the beginning period in March of 2009 that we had that actual true market bottom. And let's take a look at some of the dynamics. I do have the RSI up here. It got into positive territory, and we did have that take place during the latter part of this head fake period. But if you look closely, we're not really getting volume. The markets are not really under accumulation. So this secondary move, this break, once we got above that 50-day simple moving average, the RSI in positive territory on the daily chart, and then this MACD, that moving average convergence divergence, entered into positive territory up above 50. And if you align it, that is that true market bottom. So we also had what I'm calling head fake signals that the markets had bottomed in, for instance, 2000, but it was not until March of 03 when the markets did truly bottom. During this bear market phase, there were 15 times that the signal was that the markets had in fact bottomed using a system I'm going to share with you. But however, important to note is that the true bear market bottom does have a characteristic that will set it apart from those head fakes. So you do want to be aware of that, so that when we get the signal, you'll know that you could, in fact, participate in a new bull market phase. So here we are with that 2000 into 03. And I talked about the many head fakes that we had during that period. The true market bottom did not take place until April of 2003. So let's go ahead and take a look at why it's so important. And of course, a number of reasons that it's important to get that true market bottom, but also it is a fact that the most profitable period for investors as far as increasing your capital gains is going to be that first leg up out of a bear market period. And then it is true, a lot of people do miss that first leg because they are still hanging on to bearish concepts relating to the market. And if you've stayed in your positions, maybe you've been beaten down. But I will say, I'm going to share with you a chart that shows the returns from 1 year, 3 year, and 5 year from the market's bottom. And this particular chart is broken down by the percent declines. So your worst markets are listed up here. But most importantly, let's take a look at the returns coming out of that. This is going to be 12 months beyond that market bottom. And you can see these significant returns that can be experienced coming out of that 2020, the first 12 months, very significant. And some of these other periods are going to be not so recent. There was a market bottom called in 07. But you can see relative to that 3 and 5 year return, that first initial 12-month period is going to be where your exceptional returns are going to materialize. And circling back to my work with my MEM Edge report, I did I uncovered and shared 8 of those top 12 performers for the year of 2020. A lot of the names I did not talk about in that period were more cyclical names. They were not the growth names. So they did have very, very superior returns to the market. I'll share with you a couple of examples, but it was all about not only uncovering and having confidence in that market bottom, but also using those fundamental and technical characteristics together to uncover those big winners. So here are a couple of examples coming out of that 2020 bear market, what you want to be on the lookout for as the markets emerge from bear market status. This is Coupa. It's a software stock. So a couple of the characteristics that drew us into the markets had experienced the bottoming signals that I'll be sharing with you. And then Coupa in particular broke back above this 50-day simple moving average, and this MACD entered into positive territory. And this was all about the fundamentals as well, because analysts were upgrading their earnings outlook for the stock. It stayed on our report. Subscribers experienced a 96% gain in Coupa. Shopify is another stock that we identified coming out of this bear market in the initial days. And what drove us was the fact on this particular day, the stock gained on volume that was 100% greater than average. This is that accumulation. I would view volume as a technical indicator. It's telling you that investors want in, and we can see that the outside momentum indicators were positive. And also on this particular date, the chief technology officer, Shopify is a software platform for retailers to sell goods. And the chief technology officer stated that the company was seeing a huge surge in traffic. This, of course, was during the lockdown period. And this particular name, we held on to it. It did go on to become a 200% winner out of that bear market. And then the last example here is PayPal. And a couple of additional factors that not only got us into the stock out of that bear market, but kept us in. So here we are in that April period after the follow-through day in 2020. PayPal broke above this 50-day simple moving average. And it was on news that the government did include PayPal as one of the providers for the government loans, the PPL loans that were taking place. And that was very big news for PayPal. It would allow them to garner a whole new base of potential clients to draw from. So as the stock continued to ascend higher, the company continued to innovate. At this point here at the end of May, they rolled out a QR code payment system. And then also the stock, we did remove the stock here as it broke support, but we did get back into it. But the news at this point was that PayPal added a cryptocurrency app. They also then went on to become the first foreign company to own a payment platform system that was in China, which was all about these items. Each of them were all about expanding the company's growth. So you're marrying that fundamental backdrop where the company is poised to go on to grow with the chart. So I talked about exiting the stock here. We did enter the stock again. This particular run was an 81% gain, and then our secondary run here was 54%. But again, marrying that chart with this backdrop of strong growth prospects as we come out of the bear market is really going to get you in front of those big outperformers. So currently, as we enter into the fourth quarter of 2022, there is a lot in the way of fears of a recession. So when we enter into the fourth quarter, oftentimes technology stocks will fare well. They're very seasonal, and that is generally a good time for these names. However, we do have an entirely different backdrop at this time with interest rates and high inflation and growth prospects with talk of a recession. Of course, that's a slowdown in the economy. So the backdrop really isn't so strong at this point in time. But I did also want to share with you some of the current drivers of price action in the markets. And these drivers are not just for this particular period. It is ongoing when you are looking for areas that can signals that can impact the bigger market price action. So I'm sharing with you this 2-month daily price chart view of the yield on that 10-year. You can see that it got quite elevated up to about 3.8%, historically very, very high. As interest rates recede, this is when you can be on the lookout for growth stocks to potentially bounce, but you're also going to want to pay attention to volatility. This is also the fear index. So when you're in a bear market period, rising volatility or this index is a negative for the broader market. So you will want to have this on your radar. As volatility fades, it does provide the potential for a rally, certainly if we get back below that 50-day simple moving average. The US dollar is also another highly impactful item to be very aware of. A rising dollar, certainly at this period, at the end of September in 2022, the dollar reached a 20-year high. That was and is a negative for the broader market, certainly for those multinational companies that sell goods overseas, as a rising dollar is going to reduce their revenues. So in a falling dollar environment, you can potentially see metals, commodity stocks rise. And so there is a very strong relationship between the dollar that you'll want to stay on top of as well when you are mastering what is taking place in the broader markets, and it will give you an idea of what to be anticipating going forward. So at this time, Q4 of 2022, we are in unprecedented times in the sense that we are coming out of this pandemic lockdown period. We've had big supply chain issues because of the inability of individuals to produce goods. And then also very, very high inflation coupled with a rising interest rate. We also have geopolitical strife. So really, as it relates to items and news that can impact a market, we're being showered with all of that at once here during this period. But we can take solace in the fact that each bear market does unfold at a different pace, but each true market bottom does have the same characteristics. So let's take a look again at that 2003 at the very beginning period, actually the first 2 years of that bear market. So this is the NASDAQ 100 index, 2002, and you can see that we had this significant break at the beginning of 2000, and then subsequently throughout this period, these first 2 years, we had several very, very healthy bear market rallies, up 43%, 33%, and then of course, as we descended further, the rallies were becoming stronger. This is the beginning of 01, where we had this 55% rally and then 59%. So very interesting, because from here, I'm going to share with you that very same chart. And what I've done is marked up this daily price chart of the NASDAQ 100 with that same time period. And what I'm identifying here with this blue vertical line are the characteristics that indicated that we could be entering into a bear market rally phase. And first up, we can see the RSI turned positive. Down at the bottom, I have faster moving stochastics, and they also turned positive in conjunction with this downtrend reversal that shaped up into a 43% rally. Moving forward, and then also equally and almost more important is being able to identify when that rally has ended. So I'm taking us forward to this period when the RSI turned negative, in line with the stochastics turning negative and the NASDAQ 100 breaking below the 50-day. So as we progress through this 2002, the end of 02 period, very similar dynamics shaping up here with the momentum indicators turning positive, indicating a reversal, and then likewise as important when that rally has ended, using these momentum indicators as well as a break below key support. So quite simply, if you wanted to pause it here, you can take a look at those dynamics and you will see how consistent they are throughout those bear market rally phases. So I wanted to share with you a view from 2022. This is a chart that is focused on this rally that took place July into August. I shared with you earlier that interest rates were declining during that period, and we did see a move higher in NASDAQ and heavy growth stocks, high growth stocks. So here is an excerpt from my July 19th MEM Edge report at this juncture when the NASDAQ 100 broke above that 50-day simple moving average. I talked about that the rally on that given day did push that index above the 50-day. My prior report talked about growth stocks trending higher overvalue stocks. And on this particular date, I cited that if you are an investor, very nimble, you're confident and comfortable in the markets, you can put money to work. However, you should keep your stops tight because we were in a bear market phase and we would anticipate any rally to be fairly short-lived. This lasted about 4 weeks. Again, those same dynamics here are on the positive side, and then likewise as the index deteriorated. So here we are talking about, this is my August 22nd report where I identified the fact that semiconductor stocks were breaking down. We removed NVIDIA that we had put on here. We did remove the stock here. We also had a semiconductor stock ON that at that time during this 3 to 4 week period, it had gained 20% after we added it to our list. However, we were advising profit taking as the index was beginning to show signs of deteriorating. Lam Research, it's important. I can share with you, I had other winners in that bear market rally, Amazon up 12% and so on, but not every name is going to work. You will want to make sure you have those loss. We aim to keep losses at the most 6 to 8%. So with Lam Research, we did add it and it did deteriorate here. Once we removed the stock, it was at a 6% loss. But again, having those indicators on hand to make sure your losses don't shape up to be anything more. Oftentimes, these reversals can be pretty sharp. So at this juncture, again, the end of 2022, the economy has a huge crisis that it needs to overcome. And in particular, the fact that US inflation is very, very elevated, 8.2%. And the Federal Reserve, we talked about monetary policy. These are the police for the markets and the primary driver as it relates to any actions that they take, any comments that they are making. The Federal Reserve wants to see inflation get down to 2% over time. And this is not going to happen overnight. Inflation, once it permeates an economy and infiltrates it, it will take time to get it down, certainly to this more normalized 2% level. So we are in a period where we have a lot of work to do in order to overcome. But let's take a look here at when we will know that the markets have bottomed. I've been talking about that concept. Well, first up, you are going to want to wait until you see confirmation that there's been a change in that trend. And we talked about that change in trend with those bear market rallies as a for instance, and that certainly using your chart is going to be one way that you can identify that really pronounced downtrend has reversed. But beyond that, there is one other key component that I'm going to share with you, and that is the fact that when a new bull market phase begins, this is using historical precedents, and we're going to go back to a couple of bear market periods, you do need to see a resolution of the initial negative news that got you into that bear market period. So as a, for instance, in March of 2020, when we had that bottoming process take shape in the markets, there was a headline news item that the number of global COVID cases was beginning to decline in April. That's important to note. This is China had first contracted, actually in hindsight, in the fall of period of 2019. So that headline news was one of the items that helped propel the markets higher. The other was the fact that the Federal Reserve came in and was providing a lot in the way of liquidity. They were planning to, at that time, to help stem the crises that was taking shape. So Federal Reserve action, as well as resolution of that negative news. February 91, we had a bear market ending because what drove us into that bear market was the Gulf War. And when the announcement of the end of that war came, that was when we married that with the technical indicators to note that the markets had bottomed, taking us back to March of 2009 when the markets bottomed. This again was fiscal policy, where the Federal Reserve kicked off their quant easing program, QE. You may have heard of QE1, QE2. This is all about the Federal Reserve buying bonds and flooding liquidity into the markets to help stem the damage that had occurred from that 2008-09 bear market. The other characteristic that takes shape in a new bull phase is that leadership names, those stocks that have strong growth prospects. I shared with you PayPal, Coupa, Shopify, very high growth names. They begin to trade higher and they begin to outperform the broader markets. That's another common characteristics as we enter a new phase. So what I'm going to share with you here is a system that, again, is proven to call each and every market bottom. As mentioned, they don't all work, but this is a system that you can use. It's called a follow-through day, developed by Bill O'Neill. And again, using historical precedents going back through every bear market cycle for many, many years. So what you are going to be on the lookout for as it relates to each of the major indexes is that it will be up at least 1.4% over the prior day on volume that's higher than the prior day. But there is more than that to this. It will happen on, ideally, you want it to be in this sweet spot, the 4th to the 7th day of an attempted rally. I'm going to share with you a precise example. Sometimes it can be the 10th day or later from that first rally day attempt, but the later that it becomes, the less likelihood of success. During that follow-through day period, I talked about the fact that financial headlines are going to be negative. They will still be negative, so have that in the back of your mind. And the bottom line is that no new bull market cycle has ever occurred without this follow-through day taking shape. But as mentioned, they don't always work in a sense that they may oftentimes be bear market rallies. However, so this is why when we get these signals, you will want to carefully begin to add high-quality stocks. Let's take a look here at a very precise example on March 12th in 2009, as opposed to this head fake period. On day 5 of a rally attempt, here I'm marking up this one thin line here. That was your first day rally attempt. And as we count, you will want it to be the 4th day or beyond. On day 5, the market rallied 4.1%, and volume on that day was 3% higher than the prior day. So that is that signal that is what you want to see to signal, and it has signaled every market bottom. But let's take a look at that other extra element that I talked about as it relates to the reason that the markets, the backdrop, we did get into that bear market due to a financial collapse, and it went through the banking system. Of course, Lehman Brothers declared bankruptcy and so on. But let's talk about that March, actually 12th was the follow-through day. And what some of the headline, or actually the solid news that was taking shape on that day. And in particular, Congress held a hearing to change the accounting rules that banks were mandated to utilize, because that banking rule was exaggerating the bank losses. If you want to look it up, you can look up mark-to-market accounting on that date. I won't get into it, but the fact that they were going to change that was a huge boost to the prospects and outlooks of these very down and out bank stocks. Also, on this particular week, Citigroup had announced that they were profitable for January and February of that year. So that was a backdrop news item. So the collapse of the financial system, banks in particular, led us to that bear market. And then as we begin to see news that is going to shift the outlook for these bank stocks, that coupled with the follow-through day sparked a longer term, in fact, marked the bottom. So again, making the point that they will not all follow-through days will work, but here are some hints that'll tell you that it's not going to carry on. If you see what are called distribution day, this is the markets down on higher volume occurring within the first few days of a new uptrend, that is one of the signals that it will not take. Also, in the early stages, you want to see these top rated. I shared with you those examples, stocks breaking out of bases, ideally on big volume. So the bottom line is, when we do get that follow through signal, you want to make sure that you don't jump back in 100% on that day. Quite simply, they aren't all going to have sticking power. You want to start and begin your buying in stages and let the rally prove itself to you. This is going to be important. I mentioned those bear market rally reversals can be very swift. And as it relates to uncovering those names that go on to become top performers coming out of a bear market, the majority of those leading stocks are going to be in what are called leading industry groups. I mentioned to you in the beginning how energy came into play. That did go on to become the group. Quite simply, that backdrop as it relates to where your stock is a part of, what sector, what industry group, is very important, because 37% of your stock price movement is tied directly to the industry group it's a part of. 12% is due to strength in that sector. So roughly half of your stock's move is attributable to that industry group. So you'll want to get that right first. And then from there, the underlying stocks by looking at those high quality growth names. So so from here, I did want to mention my MEM Edge report. I am all about sharing those groups that can go on in the case of a bear market rally, also in identifying market bottoms and those big winning names. So at this time, I am offering a limited time bonus to not only for $7, you can experience a 4-month trial of this top performing newsletter. But as you move on, I do have a special on the quarterly and annual rates as well. And each of these periods, for instance, if you were to subscribe to an annual rate, it is prorated. You do have the ability to cancel at any time. But this is where the bonuses come into play. You will receive a course, a 30-minute course on the power and how to use simple moving averages. But also, there is a live earnings analysis session that is going to take place in the beginning of November. To those people that subscribe to this annual package or newsletter subscription level, you will be able to participate in that live trading room. It's going to be right after each of those major FANG stocks have reported their earnings. We're going to examine the markets, the price action, and answer any questions in this live trading room. So super excited there. There will be a link below for that. And also mentioning the fact that this is a report that is delivered each Sunday and Wednesday, as well as intra-week alerts as the markets shift in this very, very volatile period. I do alert you to those moves and how you should and can participate in any rally attempts. So I urge you to use that link below, and you can take advantage of this special one-time offer that will be going away at the beginning of November. You can use that link below. That's it for today, everyone. I look forward to seeing you at my weekly MEM Edge show here each and every Friday afternoon. Take care.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.